The largest trade in over a month in the most important sector. In today's video, we take a look as why traders and investors like you and I need to be paying attention to certain key levels. And if we stay underneath the 200-day moving average for too long, could it be causing a recession? Market structure is key, big flows are the focus, and obviously gap fills have started to occur. So where should we be looking? Well, one of our favorites is continuing to break out. Yes, there's a lot of opportunity in this market, and in today's video, we'll be taking a look at stocks, commodities, and cryptos to break it all down together. See you in just a moment. Well, welcome back everybody to The Daily Show. My name's Tom and it's great to have you here. Today we're discussing the latest macro data and of course the key levels that matter to each and every one of us. But we need to focus firstly on what exactly is going on from Wall Street's side. With tariffs starting to accelerate again into the April 2nd deadline, what exactly will happen? Will we follow Trump 1.0 or are we going to follow a totally new path? So far, since we've been sharing this particular statistic, it seems to be kind of on par. But of course, what happens at the end of the year could be totally different. The thing about tariffs is sometimes it takes a while for them to show up in the economy as there is a lagged event. So with all of this in mind, should we be actually bullish in markets? We've shared this statistic already, but I thought it's very important to really break down once again. And that is that this recovery so far has been on lower volume. And you might think, well, that's kind of unusual. That's stupid. We don't want to see low volume. We want to see lots of buyers coming out to play. Well, actually, low volume is still a pretty good sign. And as you'll notice, 1 month later and during similar recovery periods, we've seen 100% of the time the market's up. The same thing happened 3 months later, although there was the classic double dip, and that did happen. So why should we be looking at this double dip and potentially saying, well, are we seeing similar things? Well, it all comes back to understanding what point of the market we may be in. Now, there are many different people thinking about different stuff in terms of where we're at. I tend to believe we're in the late cycle of a market bull run, but many people think that we're kind of midway. And a lot of it will come back to how defensives continue to perform throughout 2025 versus things like XLY and of course financials. As you can see here, an overlay of the 1990s to right now seems to be kind of on par when it comes to the pullbacks and what to expect. And you'll notice that when we're taking a look at right now, there was still way more to come. So of course, this has a lot of bulls saying, wow, this overlay is pretty good. In fact, if you overlay Netscape, that is the old search browser, with the same thing as ChatGPT, which kind of took us out of 2022 doldrums, you'll notice that they're also on par together at the same point, at the same 1,000-day kind of market valuation. So what is happening? Well, it's maximum fear. As you guys know, we always track what's going on with fear and greed when it comes to us as retail traders and investors. And at the moment, the Conference Board 1-year expectations of stocks has absolutely collapsed. And of course, the 2-month net change is the worst in 40 years, according to Fundstrat's latest data. Now, this is a pretty big deal because, of course, it has been seen in the past as a contrarian technique. That is, when everyone is this bearish, you might want to start thinking about bullishness. And as we often say, it's important to really break this down in terms of statistics, data, and a logical approach. Are we seeing flows coming in? We mentioned at the start of today's video that we've just seen the largest transaction go through semiconductors. So what's happening with the latest AA members survey? Well, as we're already aware, everybody is still pretty low in the bull case. 37.5% historical average. We're sitting underneath that now for over 5 weeks. And this means that the bears and the negative narrative has been in control. In fact, it's so rare. We've actually only ever seen 2 other times, according to Daily Chartbook here, where we've actually seen 5 consecutive weeks in a row where bears have been above 50%. That was 1990s lows and, of course, 2022 lows. I think the interesting thing about this is, of course, this was a totally different period of time, but this one here was still very recent. And what it shows us is that what is really alive and well in markets is the way that news spreads. In the age of social media, obviously we're watching this here now either on YouTube or on X. Follow us on X in the links in the description down below. If you're watching on YouTube, you do get some extra stuff that we sometimes share there. But the thing about this all is that everyone is getting information so quickly. So it seems like fear kind of comes into the markets quicker than it ever has done. And what this is leading into is us having to be objective about the situation. A few days ago, now almost a week ago, we shared the idea that the CTAs were super underpositioned and would have to go positive on the tapes. In fact, according to the latest Goldman Sachs data, it showed that literally in all cases, they were going to have to be net buyers over the next week and in particular the next month. And it's the next month that really matters. Generally, if markets are going to pull themselves out of the doldrums, they tend to do it as they have already done off those March lows, which we've seen so far show us at about this point right now. At the same time, we can sometimes then get chop based on the last 5 years, and we tend to drive higher. Now, this is in the face of the wall of worry. Again, if we went back 21 years or even went back 100 years of data, you still see a very similar occurrence. March is well known to be a sell-off month, and April is well known to be one of the most bullish months of the year. Now, does that mean it always has to be? No. And it's important that we follow structure over the next 1 month in particular. Make sure to subscribe to the channel, as this could be one of the most important 1 month positions that we've ever seen in market structures. If markets continue to go bad, we've already demonstrated before that this, after a rate cut, is the time when markets make a decision either to go on the soft landing or the negative kind of recessionary path. And that is the most important thing that we face because, of course, everybody's calling for a recession. Are we going to get it? Let's see what the market actually has to say. Now, semiconductors versus SPY. We mentioned before, of course, the largest trade in a month on semiconductors. As of the recording of this video, semiconductors is literally back down here. And you'll notice that it's been a series of lower highs and lower lows this entire time. Now, this is semiconductors in comparison to the SPY. So it's been underperforming for literally 1 year now in terms of poor performance. That goes from the hottest market sector to the least hottest pretty much across the board. And why this matters is because it's going to be a big deal what happens here. You notice that we obviously talked about this a little while ago, which was that we saw a lot of dark pool transactions up near those NVIDIA highs only a month ago. Since then, we saw a big sell-off. Well, guess what? The largest 1 month transaction just came through near the close of the last 24 hours. And why this could matter is because if it switches trends after this and we kind of confirming that they are probably buying in, that is that they are interested in, of course, moving to the next level, then that could be a huge deal for us as traders and investors. Why? Well, semiconductors remain one of the most important levels. Another big trade that kind of happened over the last 24 hours was not so much the trade itself, but the reaction of this area on IWV. That is a big S&P 500 ETF, exchange traded fund. And this level matters because this is the largest trade we have seen ever recorded at around this price. And that's a big deal. Now, of course, it's not a new trade. It's just the previous time we saw it trade around here. But that also just so happens to be a gap fill. So if the market is able to actually recover here in the face of 25% tariffs, in the face of the wall of worry and other things, it's a kind of good sign. The 200 daily moving average on the NASDAQ, though, could be one of the most important charts, which we showed before. Let's now move over to flows. Ethereum is slightly almost going green. You can see here barely down in terms of previous flows. Bitcoin still showing strong green inflows across the board. And although this chart's going to be a little bit hard to see, as you'll notice here, this is from Tom McClellan. Basically, according to the latest reports, we're seeing Bitcoin futures showing a similar sign before actually bottoming off last time. And you'll notice that when you get down to these kind of more extreme levels of positioning, it often is a bottoming zone for the crypto markets. So this is going to be a very important point for crypto, and indeed a very important point for risk on versus risk off. Daily 200, we cannot stress how important it will be for the NASDAQ though, which we'll look at later in today's video. Let's now take a look at flows over the last 24 hours. It was defensive across the board. Gold, silver stocks, nice. We like silver, of course, at the moment. We've always loved gold for 2 years. You guys know that. Our most committed position. But on top of this, we also have staples. We also have healthcare. We've got that defensive kind of grid of the last 24 hours, and semis were down along with anything risk on. So it was a sell across the board after the tariffs. And then on top of that, we saw another kind of resell. And this takes us down from seeing semis doing well over the last 5 days to actually doing really poorly. And yeah, in Invent This, I just saw some information coming out about Microsoft as well. supposedly with their servers, which we'll have to talk about soon. So what exactly is going on? Are we seeing a mixture of risk on, risk off? Well, I find it weird that we've got consumer discretionary up here and, of course, semiconductors down here. That's a conflicting signal if ever you've seen one, but it probably is because consumer discretionary is made up so much of Tesla, and Tesla obviously found a bounce the other sessions. Now let's take a look at the S&P 500. I guess we'll say gap fill. It's not quite the way I like to fill a gap, but you'll notice by the real market, you've pretty much done it. You've gone the wick to wick, which a lot of people consider. There are two ways to look at gap to gaps: close to close, which is my favorite, and then there's wick to wick. I'll class it as a gap fill though. So we can say nice work, gap done, gap filled, market bounced off that level, number one trade zone. That's important in itself. Obviously, we also want to be looking a lot at the weekly close, which at the moment looks kind of horrendous. So Friday is going to be important, and we'll need to be looking at the options, which we'll do so in a minute. Speaking of options, here are the low and highs of the day in terms of what the market's expected to stay within. And you'll notice that we're getting a lot of trade through the 5,700 and 5,650 kind of areas, 5,600 levels. So why is this important? Well, when we dive down and we start taking a look at the 2 hour, you'll notice that the market is still kind of bearish around this area. It's coming down, it's making a series of lower highs, and it's kind of constantly showing rejections. Now, this helps us as traders because what we can do is we can say, well, if the market is able to get above these horrendous looking rejections, then it's really showing way more commitment towards the upside. So that's, of course, going to be an important point. At the same point here, we're obviously looking, what is going on with this gap fill. Are we going to class that? Yes, we are. And of course, the 5,600 level. So this level here is where a lot of people will have stop losses. If that level is lost this week, yeah, we might be going for that dip, 5,400, 5,450, and then rally up. If we manage to hold here, hold 5,600, we could easily get back to the all-important 5,850. And why is 5,850 important? It is the weekly 20 moving average. And that has been the most respected moving average on the way up. So it is likely to be hit at some point, and it is also likely to show us a sign of whether the bulls really mean commitment or not, because the bears will be trying to pressure down this level. Let's now take a look at the options, and you will see why that gap fill zone is so important here on Friday. Take a look at the OPEX here. Oh, not the OPEX, the expiration itself. We're not on OPEX just yet, guys. That just happened. But we are at a point here at 56.50, 56.75, where there are a lot of puts, and that instigates a put wall. Now, interestingly, when we go the next week, 56.50 remains very strong, and then all of a sudden we go back into the 55s. 55.70, strange strike, but anyway, it's there. When we look at the 17th of April, that's a little while away, you'll notice again, puts still stacked to the downside. And this is quite consistent with that idea that even if we go down, we're most likely going to hold up. And that's because we know when we look at a lot of 1 to 3 month stats, when the market is sold off at the aggressive rate that it has, we're either looking at sidewaysing style markets or recovery style markets. That was what the stats that we've been sharing over the last couple of videos have really shown us. When we look at something like Tesla, we're still in positive gamma. The market's actually holding pretty strong on Tesla. Down to 273, but of course, 295 remains that big strike because 300 is the main call wall. When we take a look at Nvidia, has anything else changed? Well, not so much. I mean, we've got the 110s, the 115s in terms of the put levels. We did move underneath the 115, which we know is the most traded zone. And then we've seen large transactions come in on semiconductors. It is very important that Nvidia tries to hold this spot. And we'll look at why, including a Fibonacci very soon. But you'll notice this 110 is a massive put wall. So unless the market wants to go on some kind of waterfall, negative gamma, absolute blow up fest, it realistically should be finding some support around this zone. So just before we jump into the charts and we take a look at these key levels that you need to be watching right now, I want to say a big thank you to the sponsor of today's video, which is Tiger Brokers. Now, as you guys are aware, Tiger Brokers have been working with us for quite some time, and they've been implementing a lot of your advice and feedback in terms of what you want to see in the platform. Well, guess what? That's paid off big time for not only you, but also for them. They're getting recognized in many awards across Australia and many other countries. On top of that, you get special things if you sign up with the FX Evolution codes down below. And I encourage you to have a look and see whether this is the right service for you, because you get $60 in cash vouchers when depositing a minimum of $2,000. That's a pretty good return straight away. And of course, you get extra special FX fee transactions. Now, why is this important? Well, it all comes back to being competitive in the market, which you can see Tiger Brokers is very competitive against others out there. And on top of this, it's about being able to access these international markets. You guys know that we talk about the US a lot. We talk about commodities a lot. We talk about cryptos. We talk about all of these types of asset classes. And why this matters is because you get access to 9,500 plus stocks and ETFs. That's a lot. I don't look at 9,500, but you can if you want to. And of course, you can trade them outside of hours. This is so new in the markets in Australia and again outside of the world to be able to actually access these ETFs and single stocks in a way that you can have them outside 24/5. So if you've ever thought, wow, I want to get into these US markets, but I can't do so because I don't live in the US and the timing's wrong, well, guess what? Tiger Brokers have it. Now, what are you thinking about? Check it out down below and see if Tiger Brokers is the right one for you. All right, guys, let's jump in now to one of the most important things, which is, of course, to look at the bonds market. What is the bonds market doing? Is it freaking out? Is it saying, oh my goodness, we need to get out of our position? Well, as you can probably guess, the tariffs didn't exactly make anyone very happy. And you can see here, there is a spike up in the fear that came straight back into the markets. At the same time, this is, of course, a very important zone when it comes to saying, well, if this goes back above this high and we haven't made a new lower low, that's not a good sign. That's probably saying that we're going to 5,400, 5,450. So we continue to watch that. We continue to pay attention to it. Not too many changes on things like home builders, but obviously where the changes were yields and the VIX itself. The VIX spiked back up to 18, although it's been crushed recently compared to where the panic was only a few days ago. We're fast approaching, of course, April. We're fast approaching some of these walls of worry. So we'll have to see, of course, how price action deals with this. But yeah, the VIX is where it is. Now let's take a look at high yield junk bonds. What are they doing? They're dropping. The main reason they're dropping, yields were up. US 10-year, US 2-year, all of these were up. Tariffs, of course, known by the market to often cause inflation on what they're put on. And then, of course, that is leading through to some worrying signs when it comes to the high yield junk. Now, was it bad enough? I would say no. And therefore, we're not actually seeing a complete and absolute panic fear at this stage. It's all about the price action. Let's put aside our feelings and our bias and say, have we seen the market take key levels yet? And the answer is not really. Neither for the bulls or the bears have we seen. We're trading in that range at this stage. US dollar 20-day moving average here, obviously a little bit of resistance. Finds some resistance, gets a little sell off that level. At the moment, of course, we are temporarily thinking there might be a little bit of bullishness on the dollar, but overall negative on it this year. And so far, that has been the right overall macro play. Now let's take a look at gold, all-time high. I thought gold might sit for a little bit more, but it doesn't care. It doesn't care. As we know, we're looking for 3,600 now on gold. BofA, Bank of America, B of A. They actually managed to go through and say 3,500. I saw Goldman Sachs updated theirs to 3,400. They're a bit late to the party, guys. I mean, we obviously did this 2 years ago, but still, very nice action on gold. What I'm more impressed about, though, is not so much gold. You know which one it's going to be. It's going to be silver. Look at it. Boom. This is actually very replicable. So I'm actually very happy with gold. I love silver. I love the got gold on the mind, but silver is very nice in terms of the overall accumulation levels. Obviously, the basing structure, very replicable down there, right out of our day trading masterclass course. Links in the description as well if you're interested in that. And you can see here a very aggressive movement up. Now, this is going to be great for the weekly closes. And I think this cannot be overstated on any of these pairs at the moment. Semiconductors need to hold certain weeklies. NASDAQ needs to hold certain weeklies, which we'll look at in a moment. And of course, silver closing up here. This opens up significant movements for silver. And you can see here that original head and shoulders actually about to, well, pretty much completed over here, but it's about to get ripped. And could we be going back to these 2011 prices? I'm thinking 45 is not out of the question if silver really starts to rip. And this is a very, very nice one coming off that repeatable daily 20 moving average. So again, that's going to be one you want to keep on your charts. For now, though, silver ripping, gold ripping. Probably what is that telling us? Well, people are probably concerned about the geopolitical space because they are the oldest currencies. So people often go to those. US oil has also hit its first target, which basically means it's at resistance for now. And if you've been on the oil energy kind of bandwagon, congrats to you. That is completely against most people's thought processes, but the improvement was clearly there once we took that 68.40 zone. So not too bad there at all. When we move over now to the major stocks, Tesla, of course, hitting 290, getting close to 295, not quite there. Sold off. We've still got the oversell. We've still got the tweezer. This is showing up in many positions, including, of course, the mags, where we saw the tweezer, we saw the recovery, and then we've since seen some negativity. Now, this is going to be a very interesting one because that is not exactly the candle you want to see close on the weekly. So the mags will be an interesting Friday. Can they recover? That's probably what market bulls really want to see. When we move over to NVIDIA, you'll notice that the 61.8 fib of the retracement so far has been hit. It has been rejected, so it comes back down. This gives us the previous day high to be more bullish off, 114.62. I guess the bears are trying to commit here, and this is the zone where I would see the bulls try really hard to hold it up. That is around that 110 put level. They're going to try to hold it through Friday, and if they are able to hold it and get back up here, I could be seeing a new high. So I think a lot at stake here for NVIDIA and semiconductors as we effectively are still in a very, very weak semiconductor space. Series of lower highs and lower lows. The largest trade in a month to come through on semis. No strong follow through towards the upside yet. Now, these are starting to get worrying times when you think about it. The leader becomes the laggard. If that happens, what's that telling us? I would say it's oversold at this stage, but again, price action has to rule supreme and we need to find a bid. We just have not seen that bid yet, guys, and we'll be looking for it, of course, closely. When we come over to the Chinese market, you guys can see here that we have this very strong resistance. And this is a key level because we know that we already hit that target that we had, 25,000. I'm expecting consolidation similar to gold. Now, if the consolidation breaks out to the upside, of course, you've got to think next level. So gold would be like, of course, people go 3,100, 3,150, 3,200, the $50 increments. This will be every 1,000 point increment. But for now, I'd say it's holding. And the most important chart, potentially other than semis, could be this NASDAQ one, daily 200. We lost it. That instigated a stat down here that is not good. That usually has meant that sometime over the next 12 months, markets were going really bad. And then, of course, we've come back up, touched that, rejected against it. We've filled the gap. Okay, that's good. Now you have to look for a bid. If we don't get a bid here, if we get bad weekly closes, look at the S&P 500 predominantly, that's going to be very important. But this 20,400, you probably want to set an alert for that because we take the daily 200. It's a good sign the market is trying to structure recovery. So, of course, we really need to be looking at that. And I'd say we're on first support at this stage with this current bullish action. US 2000, rejection pretty hard. Horrible looking weekly, of course. Daily itself, it is what it is. Kind of coming back down to the same levels. Not too much going on with the US 2K. It's just kind of like a series of barely higher highs and holding zones. We're going to need to see more from this. You'll notice why it stopped here. It's that high of 2100. And again, if we break that, I think the S&P is already going to be showing us strong signs. But US 2K is still in a holding pattern, slightly better than it was, but not by that much. What about Bitcoin? Pretty strong, 87, no downside on the old Bitcoins at this stage. And that's a good sign that risk is not necessarily completely off. Usually, recently anyway, Bitcoin's been getting pummeled every time the stock market's been going down by a huge factor. That didn't happen with these tariffs. So possibly, are we seeing Bitcoin showing us the way? A lot of people probably speculating on that. 92,000 plus, that's what you're looking for at the moment. Small structure up. Probably no real heavy kind of idea of a sell just yet on this. It's still just kind of consolidating, making ready for a big move. When it comes to news, core PCE is the main thing. Daylight savings time shifts as well coming this weekend. We'll update you on the weekend video. And as always, guys, if you haven't already, make sure to subscribe and come and follow us over on some of our other channels, including X, LinkedIn, etc. By the way, if you haven't already done so, you're from Australia in particular, check out Tiger Brokers, links in the description down below. So many specials for you to check out. And obviously, if you want to get access to markets outside of Australia in particular, they are one of the cheapest ways to do so. And on top of that, they've got some amazing platform stuff. In particular, their mobile app it really works very, very nicely. Thanks so much, guys, and we'll see you in the next one. Bye for now.